What is the greatest high dividend yielding ETF for income that is also free of being considered a dividend trap? Now, the further and further you go as far as trying to find the answer to that question, you realize that most of the higher yielding ETFs out there, all for the most part, are somewhat dividend traps. Now, a dividend trap, if you're not aware, is a situation where a stock or ETF appears to have an attractive dividend yield, but is accompanied by underlying risks that could potentially lead to a reduction or elimination of the dividend payments. And investors are lured in by these higher dividend yielding ETFs and stocks because they seem at the time like a reliable income stream. But there's underlying factors that make them dangerous, and when it comes to dividend traps, you're better off not investing into them at all. But what if there was a newer, higher yielding covered call dividend ETF with a new strategy that avoids the bad parts of most all covered call ETFs and implements only the good parts? Well, stay tuned into this video because we are going to be doing a deep dive into the ticker symbol SPYI, or the NEO S&P 500 High Income ETF, which might be exactly that. Now we're going to get right into it and look into this newer ETF. Right after you, please drop a like in this video and subscribe for more content like this. Before we go deeper into what this new covered call ETF is and how it works and why it might be one of the best out there right now, let's first talk about what a covered call ETF even is. So a covered call ETF is an exchange-traded fund that follows an investment strategy involving the writing or selling of call options on the securities held in the portfolio. This is also known as a covered call writing strategy. And in the covered call strategy, the ETF buys a portfolio of underlying securities, such as everyday stocks in the market. But then with those stocks, they sell call options on those securities. Now, a call option gives the buyer the right but not the obligation to purchase the underlying securities at a predetermined price later on in the future. Now, the predetermined price that's agreed upon is known as the strike price, and the agreed upon future date is known as the expiration date. Now, by selling call options, the ETF collects premiums from the buyers of these options. These premiums generate income from the ETFs, so the covered call ETFs distributes most of this premium onto the shareholders of the covered call ETF. Now, you're definitely probably familiar with covered call funds like JEPI, JEPI, or covered call funds like QYield, QYLD. But like I was saying during the intro into this video, most of the covered call funds out there are more or less dividend traps. And in my opinion, this is simply due to the overall covered call fund strategy. But unlike the others, SPYI is a covered call fund, but their strategy is much different, which we're going to go through here in a second. So SPYI, or again, the NEO's S&P 500 High Income ETF, is a monthly paying covered call ETF. The distribution yield as of last is 12.29%, which is extremely high. The expense ratio is more or less in line with most other covered call funds at 0.68%. So it is on the higher end of an expense ratio, but again, that's sort of industry standard for this type of investment. Now, looking a little bit deeper into how this fund works and why it's so different compared to most of the other covered call funds out there. So it's its targeted benefits of the SPYI strategy. Number one, the fund seeks to distribute high monthly income generated from investing in the constituents of the S&P 500 index and implementing a data-driven call option strategy. So far it sounds pretty good, but doesn't really sound all that much different than any other covered call fund, right? Next is number two, actively managed by NEOs. The fund seeks to take advantage of tax loss harvesting opportunities, in addition to utilizing SPX index options classified as Section 1256 contracts, which are subject to lower 60/40 tax rates. Now, if you're a little bit confused by number two, I'll make it very simple for you. Basically, this fund has found different tax loopholes for the most part, in order for the SPYI investors to have a much better tax treatment. Which brings up a good point, because that's one of the other bad things when it comes to most of the other covered call funds. A lot of times the income that investors are paid on a monthly basis from other covered call funds out there, they sometimes are taxed as unqualified dividends or even short-term capital appreciation, which can of course in certain circumstances make the tax bill for the investors much more expensive at the end of the year. But the actively managed fund SPYI seems to have an idea and a little bit of a loophole to try and get the tax bill down as low as they can with this new strategy. Now, obviously, when dividend investing and really investing at all, you really should try to understand at least the basics when it comes to tax treatments and different investments and how it all works. Because as you get further and further into your investing strategy, and as you get more money to work in the market, the tax bills can definitely add up if you don't know what you're doing. Now, number three, the fund utilizes a call option strategy that may include both sold and purchased SPX index options, which may provide an opportunity for upside capture in rising equity markets. So this is yet again another really cool aspect of this fund that most other covered call funds don't utilize. So this covered call fund actually buys calls as well. So with part of the fund's allocation of money, in certain circumstances, they will actually buy S&P 500 index options, which in the case of rising equity markets, which means let's say the stock market for whatever reason starts to move up very, very quickly. With most other covered call strategies, this can be a hindrance on the fund because covered calls do have a cap on the upside potential. But if this fund is actively utilizing the strategy of buying call options, that means that if the market starts to move up quickly, let's say, then this fund will be able to capture some of that upside, which once again for the second time is not normally captured with most other funds similar to this. And the SPYI's investment objective is the NEO's S&P 500 High Income ETF seeks a high monthly income in a tax-efficient manner, with the potential for upside appreciation in rising markets. So far it sounds pretty good. And like I said at the beginning of this video, in my opinion, this fund pretty much took all the good things from most covered call funds and then also looked at some of the bad parts of most covered call funds and made a well-rounded combination of both of it. Now, more facts about SPYI. The fund's inception was 8/30/2022, so this fund has only been around for a matter of months now. Keep in mind, and as we've talked about in previous videos, track record and historical performance is something to take seriously when it comes to investing money in the stock market or really anywhere. So unfortunately, even though this fund so far seems really, really great and seems like it has a lot to offer, there's not all that much historical data to go off of. Another important aspect of this fund is the assets under management. And as of right now, it looks like the fund has around 72.2 million in assets under management, which obviously makes it much, much tinier compared to most of the other behemoth covered call funds. But this fund has been gaining assets pretty quickly, and I would not be surprised if this fund grows rather quickly. Now, digging a little bit deeper into SPYI's performance on the max time frame first off, this ETF is down around 5% more or less, which isn't necessarily all that much of a problem because this ETF does pay such a consistent high dividend on a monthly basis. So even though on the max time frame the ETF is down a tad, I personally as an investor in SPYI am not that concerned about it. But as I mentioned earlier on towards the beginning of the video, this ETF is actually green year to date, up 3.13%. Now, it's no secret that investors don't necessarily buy into SPYI to make some huge money off the price return. Investors are mostly buying into something like this to earn money on the dividends on a monthly basis, and hopefully maybe on top of that earn a little bit more off the ETF price long term. But to look a little bit deeper into this ETF's dividend yield, right now it's at a 12.14% trailing 12-month dividend yield, which I as an investor have been very pleased with, and like I said a little bit earlier, the monthly paid dividends have been rather consistent, at least so far. Now, it's important to note that this ETF has only been around since around September of 2022, so a little bit over a year. We don't have all that much data to go off of. But at least for the most part, this ETF has been paying around 47 to 49, even upwards of 50 cents on a monthly basis every single month, which has by all means given investors like myself a decent return that we can sort of rely on at this point. But it's important to note over the same time frame, other investments have also done pretty much just as well. Now, lastly, I thought that it'd be fun to chart out SPYI and see exactly what this ETF has returned if we look at total return as the metric, which is dividends plus price return included. So on the 1 year time frame, around 364.65 days. This ETF, even with the massive dividends, has returned 12.59%, which honestly, normally speaking, I would say that's absolutely great. And for me personally, I look for anywhere from around 8 to 15% return from any investment across my portfolio. I'm honestly pretty thrilled with anything within that. But within this given time frame, keep in mind a lot of different things have returned even more, such as things like the S&P 500, even other high yield ETFs like JEPQ and SVOL, just to name a few. But year to date, SPYI investors really cannot complain. With dividends and price return included, we're looking at a 15.18% return, which sort of solidifies the point that SPYI does have some potential long term, or at least it's safe to say that this ETF has done pretty good so far. But I want to hear from you guys down below. Is the SPYI a high income ETF that you personally would hold on to long term? If you enjoyed this video, make sure to please drop a like in the video and subscribe for more. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.